Right, hello everybody, and good morning. It's great to be with you all this morning. We've got some really good numbers signed up for this webinar, so it's a pleasure to have you all with us. So it's a year to the day since Stephen Yu last joined us for one of our Pulse webinars, and it's a delight to have him back by popular demand, I might add. And he's going to be talking through the topic of, I suppose, holding your nose and investing with conviction in an increasingly uncertain world. As I say, there's a very good number signed up to listen this morning. So thanks again for being with us. Also a few keen listeners, I think, within Novia Global, because last time Stephen spoke with us, he mentioned NVIDIA shares, and we've all kept a very close eye on them. And it's fair to say that if we'd all listened to Stephen and invested in NVIDIA on this day last year, we'd have seen some very healthy returns from those. As usual with these webinars, we do have a question and answer session at the end. So we would ask that if you've got any questions you'd like me to put to Stephen once he's finished his presentation, please send those to us through the Q&A function, and that will enable me to fire those towards him at the end. So yeah, without further ado then, I will hand over to Stephen to take the reins. Thank you.
Good morning, everyone. Thank you for joining us. So today I thought I would probably take you through some of the opportunities that we have got in the fund. And there's many things that have happened since we chatted last year. And yeah, I'm sure we could probably touch on some of this in the Q&A as well if you have any questions. And before we do that, I thought it's worth just having a very high-level recap in terms of our investment philosophy and our investment process. Then I will take you through some of the opportunity that we are running in the fund today. In terms of the investment philosophy, is very simple, that we aim to invest into high-quality businesses at an attractive price or valuation. So the investment philosophy over the last 6.5 years have not changed. So we started running this strategy back in September 17 until today. The overriding criteria within the investment philosophy has been the quality criteria. So quality is the most important thing in terms of what we're focusing on. Once we have identified company of high quality, then we could assess the valuation, whether they are trading at an attractive price, whether the upside potential is going to be promising, and then we can reposition the portfolio accordingly. In terms of the investment process, the way that we implement the philosophy is through doing fundamental research. So there are 6 of us on the investment team, including myself. And at any one point in time, we'll invest in between 25 to 35 companies. So it's more of a mathematical formula that when you have 6 people, let's say on average, we cover about 30 companies in the fund, then we just ended up doing a lot more work per company than some of our competitors. Let's say maybe some other team might have 2 people or 3 people covering 30 companies. Or maybe you also have 6 people, but you're covering like 100 companies. So we just ended up doing a lot more work in terms of our understanding of our businesses. And what we don't do is we don't speak to any sell-side analysts, or we don't read any brokers' research. So everything is done in-house through the primary sources, going through any reports, company transcripts, conferences, analyzing competitors, any reports, conferences, transcript, and a lot of data points on the internet as well, such as job postings and gaming downloads, etc., etc. Once we have done all that, then we will build a unique financial model for every holding we have in the fund. And what we do with that is we would then make forecasts in terms of how much money or free cash flow we would expect our company to deliver in the next 3 to 5 years. And this is also where the valuation exercise comes in, that we want to ensure our shorter term forecast will remain ahead of the market expectations. At the same time, our medium term forecast, which is up to 5 years, that the free cash flow yield adjusted for that valuation metric, is going to be very attractive, adjusted for the quality of the business in a few years' time. So we continue to refresh our framework or numbers for in terms of how much money the company will make in the next couple of years, and tying that back to valuation. So this is very important. And of course, we would we follow quarterly earnings updates. We refresh the model. So on a continuous basis, we just look forward by like 3 months every quarter, and then you roll forward that to the next 3 to 5 years, etc. We cover around 100 companies globally, and the sectors would range from luxury brands, staples, medical equipment companies, some technology names, payments, software businesses, etc. So we try to avoid any low quality businesses in the market, which there are plenty of those in the global space. So how do we actually go about kind of defining whether a company is high quality? And I'm going to give you an example as well once I run through this. So it's probably pretty generic, I would say. I think most quality manager might have a similar slide to this, but to us, it's more to do with how you translate the understanding of whether a company is high quality or not into the actual company, which I think people could argue differently, even though that they might have the same criteria. So what we focus on is we like company that can deliver high return on invested capital. So that is a starting point, and that will link to the business being being not easily disrupted in terms of the business model. At the same time, that it has very high market share, pricing power, very high switching costs for end customers, so they can't easily just switch to a competitor's product. And at the same time, we like company that can grow over the next couple of years, rather than they're just going to pay you a dividend with no growth prospect. So we want companies that can sell more of their products or services over the next coming years, so that they would be able to make more money on the back of that. We also like companies that are less sensitive to macro uncertainties, which we have plenty today. I'll come back to that. And at the same time, a company with a strong balance sheet and a good management team. So most of our companies within the Blue Whale growth strategy are net cash. So we don't have many companies that have that are indebted within the fund. So that would give our holdings a lot more leeway when the macro is a lot more uncertain, or the economic cycle is a lot uncertain. So that's how we go about this. But what I thought is quite relevant, which we haven't talked about this last year, was how does NVIDIA would fit into this framework. So this is the example I'm going to give you. That there's been a lot of talk about NVIDIA, and I'm sure you have followed the share price or the market cap of NVIDIA since last year, that not only that it surpassed $1 trillion of market cap in about maybe June or July, 7 months ago. At the same time that now NVIDIA has surpassed or very close to $2 trillion within a very short space of time. And there's still a lot of debate in the market that, NVIDIA is selling the GPU, which is the graphics processing unit. GPU is something that's a lot more robust than your CPU, which you will find in your PC or laptop. And some people would suggest that, this is just a piece of hardware. And AMD, as another prominent kind of up-and-coming competitor, is launching something similar, and people could easily just maybe switch away from using NVIDIA GPU to AMD GPU, for example, and NVIDIA would no longer be able to make more money on the back of this artificial intelligence opportunity. Okay, I think that is there's a lot of misunderstanding or misconception of what NVIDIA business is. So let me take you through why we think NVIDIA is a high quality business, going through some of these pointers here. So I think the first and foremost, we need to understand that NVIDIA GPU is very much linked to the software development that goes behind the scene that we don't really see ourselves. And we have done a bit of a case study ourselves within Blue Whale. So currently, as investment managers, we use Office 365 through like the likes of Excel, computing, building financial model, making forecasts, using PowerPoint, using Word, Outlook, etc. We also use Bloomberg Terminal, and we have the Excel add-in set up to download data from Bloomberg or from different other sources as well. And then some other applications like maybe Salesforce or Adobe, some Adobe products as well, or maybe PDF editor. But what is interesting about this is if we decided from the company perspective that we want to spend, let's say, £2,000 or euro to buy a NVIDIA GPU to put into our PC, and we are hoping that, okay, our Bloomberg application or Excel application is going to run a lot faster or more robust in terms of experience. That is not true. So basically, what it means is none of the applications that I just talked about earlier are optimized to run on a GPU. So let's say if we have a GPU on our PC, we are going to have the same experience as we have today. So it's not going to enhance our experience or not going to make the computing a lot faster. But if, let's say, you are an architect who use Autodesk to design a building, if you are a creative professional that would use the Adobe Photoshop or maybe some video editing app, or if you are a gamer, a PC gamer that want to play like Call of Duty, which is by Activision, that all these programs are optimized on a GPU. So what it means is you can equally run all this application on a PC without a GPU, and it would be very slow. The experience would be very fragmented in terms of the experience, because you might want to change the filter on your photo in Photoshop, but then it might take a few maybe 1 or 2 minutes for that to be refreshed rather than like real-time refreshing, just because the programs are not optimized to run on a GPU. And of course, then you have to link it up with who is doing all this. Like you're referring to the developers, software developers who are actually making this available to those kind of applications. So basically, the moat behind NVIDIA is the software development, that they have this programming language called CUDA, C-U-D-A, and any artificial intelligence scientists or software engineers to date over the last, let's say, 10, 15 years would have been trained on this programming language called CUDA. And in order to do anything on a GPU, whether you're going to write an application, let's say ChatGPT, or maybe the Copilot, or maybe some others that is yet to come, you need to be able to program the GPU using the language called CUDA. So, of course, over the last many years, because NVIDIA started the business just about 30 years ago, they have been a pioneer in terms of how all these things fit together, the software, the hardware. And when AMD decided to say, okay, we want to launch a similar product to NVIDIA, maybe at a cheaper price, with a cheaper price, and so that to incentivize customers, you can then now embrace the AMD GPU rather than the NVIDIA GPU. The problem with that is within, let's say, a reasonable time frame, let's say a couple of years, firstly, the hurdle is to convince any software developers to learn the AMD programming language, which is not CUDA. Secondly, because NVIDIA has been a pioneer doing what they're doing today, there are many libraries that have been built using CUDA over the last many years. So from a software developer perspective, there are many basic computational kind of algorithm that you don't have to write from scratch. Like things has been already, some of this code, most of this code has already been written. What you're doing as a software developer is to overlay what you want the program to do without actually programming the basics, which is very important. That's very important in terms of time and efficiency. And so then for AMD product, the equivalent of GPU, to take market share from NVIDIA, that they need to have all these libraries built as well, which would take some time. It's not going to be like tomorrow or next year. It will just take quite a while to do that. So this piece of the jigsaw would really like give NVIDIA the moat in terms of why we think it's a high quality business. It's not just a piece of hardware, and the business model in itself is not easily disrupted, despite the fact that, okay, someone else is trying to come into the space as a starting point. And at the same time, you have to remember that NVIDIA doesn't just stop developing or improving its GPU or the libraries as of today, right? They continue to power ahead. They are going to launch an even more robust GPU in the second half of this year. And that would then go into like a virtuous cycle in terms of more applications could be run on this, more software engineers. So that is not as simple as just a piece of hardware. Of course, then when you look at other pointers, such as the balance sheet, is net cash in NVIDIA's balance sheet. The management team, Jensen Huang, co-founded the company 30 years ago. He's still running the show. So we would rate the management team to be very high quality. And at the same time, macro sensitivity, as we all know, that NVIDIA is able to transcend some of these macro uncertainties because of the penetration of artificial intelligence or on the back of generative AI over the last year or so. So they are able to sell more of their products and services despite that the macro is very uncertain. So I just want to give you a picture of how NVIDIA would fit into being a very high quality business. So what I've got here are some of the opportunities that we have in the fund. I would probably touch on them on a very high level. If you have any questions, feel free to come in the Q&A, and then we can expand on some of these opportunities. So within the portfolio in itself, if I take you back slightly, let's say maybe more than 3 to 6 years ago, or when we first started, that we had many more opportunities within digital transformation. So at the time, digital transformation was a big opportunity set through e-commerce, software, digital payments, digital advertising, cloud, and many others. And we did relatively well on the back of those names before the pandemic, during the pandemic. But what we recognized in 2022 was we are now in a new regime. And this regime, which could last for many years to come, that is a lot less friendly than the regime that we had before the pandemic. What we have today is a lot of geopolitical uncertainties on the back of not just the Ukraine crisis, at the same time what's going on in the Middle East. On top of that, we also have a bit of uncertainty in Asia Pacific between China and Taiwan. And on the back of that, of course, you have the reshoring, kind of de-risking, which will lead to high level of inflation compared to pre-pandemic period that everyone were friends. It's very much to do with globalization before the pandemic, probably 10, 20 years beforehand. Now we're talking about deglobalization, and deglobalization would be more inflationary than globalization. It's just as simple as that. And at the same time, we would still expect energy prices to remain high on the back of geopolitical uncertainty, especially in the Middle East. So when you link all this together, that we would expect interest rate to stay higher for longer, which is unusual compared to before the pandemic period. And one thing that came out from some of this uncertainty is we are very cautious about consumer discretionary spending. Because as we all know, sitting here in Europe or in the UK, that if you have a mortgage, you would be remortgaging your house or flat at a much higher level of interest rate going forward, assuming that interest rate doesn't go back to 1 to 2% imminently, which is not our base case scenario. And at the same time, the energy bills, at the same time, the things are becoming a bit more expensive, which is what we call the stagflation, with not much growth, that we're getting less value for the money that we spent on, then we would be very selective in terms of where we want to spend our money. So compared to the good old days during the pandemic, that the government were actually handing out paychecks to consumers like us, and then we can spend a lot of money without thinking about things. But going forward, the government firstly is not handing out any more paychecks. At the same time, that most of our money are now going to places that we probably could avoid doing, and then hence the discretionary spending decision is going to be a lot more selective. So we are very cautious about the world, the economy in general. So what do you do in that sort of scenario? So this is kind of how we are positioned today. So two things that you do in this kind of scenario. The first and foremost is you invest into companies that can sell more of their products or services, irrespective of the macro uncertainties. So in today's context, the only relevant kind of opportunity within that space is artificial intelligence. So we just talk about NVIDIA. I would not expand on this now, but if you're interested, we can talk more in the Q&A. And there's some other adjacent opportunities that link to NVIDIA, such as Microsoft Copilot. They have just launched that last year. They are charging us $30 a month per user. We would argue that that's only the starting point. That price could increase dramatically over the next coming years if Copilot proved to enhance efficiency within the enterprises or white collar domain. And then you also have Adobe that have launched an equivalent product similar to Midjourney called Firefly. So instead of being a creative professional that would basically be doing the different filtering manually, cropping out objects from the photo, changing the backdrop in the photo or campaign manually, like you can now do something similar like ChatGPT within Adobe. So basically what you do is just you go to the Adobe Firefly and then you say, okay, can you remove any objects apart from the central character, change the backdrop to a kind of a sunnier, or change the lights to maybe to the kind of like different light setting, and it will be done for you. So the power behind this computing kind of image generation capability is that we are going to have more personalized adverts going forward. And previously, it's not possible because you can't ask a creative professional to create like 1,000 campaigns based on the same kind of setup or selling the same kind of product. But now with generative AI capability, you can easily task Adobe's Firefly to create not thousands, but tens of thousands of different campaigns on combinations and variants. So that is going to, we're going to expect a further explosion of content in the digital world on the back of this. So then the question to ask is, which company in the world have the most data about consumer? There's only one company in the world that have that data set. This company is called Meta. Through Instagram, Facebook, and WhatsApp, they have an average daily users of 3 billion people. So 3 billion people every day would have used at least one of the 3 apps that they have. So some of us would use one, some of us would use maybe 2 or 3 of those apps by Meta. And so then for all this personalized ad campaign that's been created, let's say through Adobe's Firefly, let's say you can imagine like Nike, if you go to Nike, they have many different pairs of trainers, different colors of shirts, hats, or other gadget that or wearables for sports, or for people who like running or other things. You can easily just task generative AI to create like multi layers of variants of all those campaigns, like with the different combination, like pink matching with blue, with maybe gray trainers and with a hat that's very different color. But then you need a company to deliver that campaign effectively, right? Like you can't just put it on a billboard. You can't just put it on the Nike website, because then we are seeing something quite generic. You need a company that can actually deliver the campaign very effectively to the end users, and at the same time knowing what the end user like or don't like. And Meta would be the perfect medium to deliver that, or mechanism to do that. And if they manage to do that, then advertisers are likely to pay more money, because the likelihood of us being converted to be a customer, seeing something that we really think in our head, that's exactly what I want, rather than I go to the Nike website, I have to spend like a couple like minutes to scroll through, oh, I don't like this color, I don't like that design, and then I have to find a matching clothes and all that stuff. It's just quite time consuming, and maybe you miss some of the things that you actually could buy. So they come to you directly with that, and so that is very exciting. So the last point I would make on Meta was that we actually exited our position in January 2022, before the massive sell-off that came after. And then we revisited Meta in last year, and then we ended up initiating our position in Q4 in 2023, and then we quickly brought it up to a top 10 holding in the fund. And so the fund has benefited from the Meta share price increases this year quite significantly as well. Okay, so the next set of opportunity is, what do you do if you can't find enough of companies that could do quite well, irrespective of macro uncertainties? Is you want to invest into companies that could actually benefit from some of these macro uncertainties. So I would give you one example, and some of them I've already talked about, like energy. We have this very high quality company called Canadian Natural Resources that we added in Q4 2022, and it did very well in 2023 as well. Visa and MasterCard, we believe that inflation is going to settle down at a high level. What they do is they charge a fee on a nominal spending. So let's imagine if inflation was at between 1 to 2% before the pandemic, and going forward, that number could be 2 to 3 or 3 to 4%. They are just going to have a natural tailwind in terms of how much more money they would make over the next coming years. Interest rate, we'll expect that to stay high for longer. We had a position in Charles Schwab, which didn't do well in 2023, but then we'll expect that to do well going forward on the back of the high level of interest rate, that they would make more income on the back of that. We also have some selective opportunity within the medical equipment companies, such as Sartorius in biologics. So if you're interested, I can talk more of these names in the Q&A. So the one kind of opportunity that I want to highlight here is reshoring, which is through Lam Research and applied materials. So what I've got here is, it might be a bit unusual, because you would think, okay, what's going on with this reshoring opportunity? Why is that got to do with the technology companies, right? Typically, when people talk about reshoring, you're talking about moving away from China, such as manufacturing of clothes or electronics, to, let's say, Vietnam, Cambodia, or maybe going to Mexico, or even going to India, etc. That is true to a certain extent in terms of reshoring, but as we all know, the logistical kind of advantage that China has cannot be easily replaced. So people are talking about China +1. So you still need China to do majority of the heavy lifting. So that reshoring is happening, but then it's not as significant. But what is really significant when we just talk about reshoring is the silicon sovereignty. So as we all know, over 90% of the high-end semiconductors are being produced in one single place today, and that place is called Taiwan. Of course, you would have read that there's a lot of kind of headline that China might want to take back Taiwan. US is trying to probably come into play and protect Taiwan and all this stuff. So, okay, whether it's going to materialize or not, or how it's going to materialize, maybe a topic for another conversation. But because of this, that Western government are very concerned that, let's say, if Taiwan disappeared tomorrow, that we would no longer have the high-end semiconductors, which is being produced by TSMC in Taiwan today. And what it means is not only that you don't get the NVIDIA GPU, you don't get the iPhone chip, very high-end chip, you don't get the chip that's going into your EV vehicle, the infotainment systems. There's a lot of things that we require very high-end semiconductors. And so what the Western governments has done is they have come out with tax subsidies. So the US have the CHIPS Act about 2 years ago, which is worth $50 billion. And then we also have the similar package in European Union, which equate to 50 billion euros. So in total, we have over $100 billion worth of tax subsidy to incentivize companies to build new foundries outside of Taiwan. And that $100 billion worth of tax subsidy have translated into more than $300 billion worth of commitments. So what I've shown you in front of you, this slide here, is where are all this new foundry happening in Germany, in France, in the US, in Japan, in South Korea, etc. And of course, if you are selling the mission critical equipments, which are the likes of Lam Research, Applied Materials, or even ASML, then you will end up selling more of the equipments to these new foundries compared to before. So you are actually benefiting from this geopolitical uncertainty on the back of reshoring, which is quite interesting, and that has never happened in the history before, and hence in today's context, like Taiwan control over 90% of that production capability, and that is changing as we speak. So we do like the semiconductor equipment companies for this context. So this is just to show you our top 10 holdings at the end of January, and some of the end market exposure and revenue exposure based on end market, which is slightly different to the geographic exposure done by listing that you see on the fact sheet. And I will stop here and see if there are any questions.
Great, thank you very much indeed for that, Stephen. That was a really interesting listen, and we have indeed had some questions through as well. So just picking through them here. So some of these bits I think we may have covered already. So I note obviously you mentioning about consumer spending, and I think from my A-level economics days, I remember you might refer to, you talk about investing in goods that are sort of inelastic in demand. But one of the questions we've had is, what do you think are the greatest risks that you and the team are considering for the rest of 2024?
Yep, thank you for that. So I think that there are two things that is quite relevant in terms of risk or uncertainties. So the first one is probably not prominent, but it is possible that interest rate is going to go up rather than stay unchanged or to go down. Okay, if you look at the performance of the fund, we did not do well in the first half of 2022. the first 6 months of 2022, the strategy lost about maybe 30% in that period. But then we had experienced a very strong recovery based on company fundamentals since July 2022 until today. And that the strategy is up over 50%, 50. So we are now doing a lot better compared to before. But then when we look at the reason why we didn't do well in the first 6 months of 2022, it was mostly to do with the interest rate increases, changes in expectations, which happened quite quickly. And of course, at the time, you might recall that Microsoft share price has gone down by more than 25%. NVIDIA equally has gone down about over 50%. Okay, some of them are for different reasons, but most of our company has gone cheaper over that period or being derated in terms of valuation within a very short time frame. So if your view, which is not our view or not our base case scenario, I don't think anyone is expecting that within the market, is interest rates actually going to go up rather than either stay unchanged or to go down. Then if it does happen, then we would see maybe not a similar negative impact, but we would see some impact because interest rate, of course, you're not going to say, oh, it's going to go up from 5% to 10%. It could be up, let's say 5% to 6%. So the incremental increase is a lot more, it's less significant than going from 2% to 5%. It's just mathematical. So that is one, but I think that's a view that you have to take. The second risk, which is probably something that is a black swan and you can't really model, is another major geopolitical kind of conflict that happen anywhere in the world, okay, whether it's going to be in Asia Pac or there's going to be further escalation in Ukraine, in Europe, or in the Middle East. Of course, when you have some major conflicts going to take shape, it's not good for equity market or people want to de-risk. And that is something we would expect. This uncertainty is going to stay with us for quite a long time. So it's not just for 2024. Like if we manage to go through 2024 with not another major conflict, it doesn't mean like in 2025, 2026, 2027, that likelihood is going to disappear. So it's just one of those things you need to be monitoring quite closely. Of course, I mean, we have some exposure, let's say in the energy space that could benefit if oil price does go up, but then other stocks within the fund would give away some of the gains that they have made so far. So these would be the two major risks that we're seeing.
Great, thank you for that. The useful answer, and one that covers off actually one of the other questions I've had regarding the performance of the fund in 2022. Lots of questions on NVIDIA, as we were perhaps expecting. So the first, again, you perhaps covered this slightly already, but the question is that it's performed very well and the share price has risen significantly. Have you trimmed your position at all? If so, why? I'll then follow up actually with another question we've had on NVIDIA, and maybe you can answer both as one. So have you trimmed the position? If so, why? The next is interested to hear your thoughts on where NVIDIA is going from here. Is it potentially overvalued? Is the tech bubble as a whole potentially overvalued? And by the user's own admission, a rather tough question to answer. Interested to know which companies, perhaps other than the ones in your fund, you think stand out as having the potential to be the next NVIDIA from a growth perspective.
Right. I would try to shorten my answer within 5 minutes because it's not an easy one that I probably need more time. Just maybe we need to do a separate session just on NVIDIA in itself for maybe half an hour or more. So firstly, in terms of the positioning, our position in NVIDIA, that we have not reduced our position since last year. So if you recall, that we had already a very large position, which is about over 7% in Q1 2023, before NVIDIA reported the Q2 numbers, that the share went up by over 25% in a single day. And so on that day in June, the position that we had in NVIDIA became a 10% position, which is just above. So we were forced to take it back below 10% because we are constrained by the UCITS rule that no single position can be more than 10%. But since then, we have not reduced our position at all. And of course, we just mentioned that NVIDIA at that time was a $1 trillion company. Now it's $2 trillion. So we managed to capture the economics in terms of the share price increase over the last 7 months with very close to 10% position in NVIDIA. We are not planning to trim our position as we speak, based on our view on valuation and company fundamentals. So to focus on maybe the valuation first, on a very high level, I don't know if you have probably done the numbers yourself. If you look at 1 year forward PE ratio, which is not something that we look at. I mean, we forecast free cash flow, we look up to 3 to 5 years, but just to make it simple, if people typically want to look at PE ratio, 1 year forward PE ratio based on consensus numbers, not our numbers are higher than that, that is trading at a similar valuation to Microsoft, Apple, and Amazon today. And is 50% cheaper than Tesla. Right? So NVIDIA is trading at just over 30 times PE, and Tesla is trading at 60 times PE. And 30 times PE is very similar for Apple, Microsoft, and Amazon. So if you say, okay, NVIDIA is expensive, then so are Microsoft, Apple, and Amazon, which could be true, but that is something of another debate. So I'm just trying to give you an idea that, okay, on a very high level, NVIDIA haven't stood out being a lot more expensive, which is kind of the misconception in the market, because you would think, like, how is it possible that the share price of NVIDIA has gone up over 200% over the last year or so, or 18 months or so, that the shares are now not more expensive? Oh, actually, it's quite simple. Like, you should not be focusing on share price movement, which is exactly what we don't do. You focus on company fundamentals, which is the earnings power of NVIDIA. So if you track the profit, let's say you do the similar kind of exercise, look at the EPS increases or the revenue increases. Like 2 years ago, NVIDIA's revenue was at around $30 billion. This year, we're expecting NVIDIA to deliver over 100 billion of sales. So the sales number have increased by 3 times, and the profit number have gone up equally because they have a very high margin business. So then why wouldn't it be the case that the share price would equally reflect that? And if you really look at the valuation of NVIDIA, because we initiated our position back in June 2021, and NVIDIA in December 2021 was at the market cap was at $800 billion. Okay, December 2021. Okay, 2022 it didn't do well, so it went down quite a lot, and the market cap trough at around 300 billion. Okay, now the company is $2 trillion. But if I look at the valuation of NVIDIA back in December 2021, where NVIDIA was at $800 billion of market cap, the valuation was a lot more expensive than today. Of course, the company is a lot bigger now, but with a lot more substance. Like, we did not have ChatGPT, we didn't have Copilot, we didn't have the Firefly, we don't have everything that people talk about in terms of AI, the chatbots, how that could change the world, etc. So it's very important to focus on the company fundamentals or the earnings power of NVIDIA going forward. The last point I would probably leave here before I take other questions is, okay, NVIDIA today is $2 trillion. So what does that actually mean? Okay, we are looking at Microsoft, Apple being a $3 trillion company. If you really believe in how artificial intelligence, which is mostly to do with generative AI, that's going to change the world, how much more efficiency is going to create, how much more increase in productivities, like for any company who utilize that would probably benefit from, that you could question, why couldn't NVIDIA be a $3 trillion company, if not more? Like, I remember like 2 years ago, or maybe 2.5 years ago, when Microsoft became a $1.5 trillion company only about 3 years ago. There was a lot of headline in the UK, if you follow the UK stock market, to say that how is it possible you have one single company called Microsoft being $1.5 trillion? That is the same size as the entire UK stock market, which have a few thousand companies. That must be a bubble in Microsoft share price. Like, that's not right. Look at Microsoft today. It's $3 trillion. It's still bigger than the UK stock market. So I think I recently saw something on LinkedIn that people are saying NVIDIA $2 trillion market cap is similar size to the UK stock market. It just reminded me, like, people are not following what the company actually doing or the implication of that happening. But I probably don't have time to elaborate more in terms of why we're so positive about the development. There's a lot of things. I mean, I would encourage you to probably just maybe follow some of the developments, because it's happening so quickly, and there's a lot of profound implications for our day-to-day as well. And I would expect, if we do have an update call this time next year in 2025, there are more things that we can talk about on the back of this development. And we do not believe that this is a bubble of any sort. And at the same time, the implication is very real and potentially profound as well for society.
Great, thank you. So perhaps not too late then to jump on board with NVIDIA for those that haven't. So as I mentioned, lots of questions on NVIDIA, but probably best to try and move on and ask some others, because that was a great, very detailed answer there. I had a couple of questions regarding Nintendo. So the first is, what is the rationale for holding Nintendo stock as one of your holdings? And the next, just carrying on from that, a question regarding Nintendo. Some view this company as old school, i.e. tech that predates the Xbox and the PlayStation. Is the Switch 2 a make or break thing for them, and or could someone like Microsoft potentially buy them?
Yeah. Oh, thank you for that. I mean, that's an unusual question. We haven't got a question on Nintendo for quite some time. So we had investment in Nintendo for a couple of years now. It has done very well for us in the fund. And I think there are a couple of things that's going on. I think firstly, in Nintendo's business is mostly to do with its IP rather than the piece of hardware. So if you're saying you're comparing Switch versus the PlayStation versus Xbox, then yes, of course, it's a very different way of kind of delivering the gaming experience, which is maybe you can argue it's not as robust as the PlayStation and some others. But what Nintendo is really kind of valuable in terms of the asset is the IP, is the Mario, the Pokemon, the Zelda, etc., which is only which belongs to them, right? That is their IP since they started the business many years ago. And what you would have seen over the last few years, despite the fact that we haven't got a Switch Pro coming up, that has come to the market, which we are expecting that to happen in 2025. So the latest development is they're going to launch a Switch Pro in 2025, but then it hasn't happened for the last few years. How did Nintendo manage to do so well over the last few years without a major upgrade in Switch? Okay, firstly, they are still benefiting from a transition from selling their games through hard copies to digital download, which they have been a bit behind the curve. If you look at the likes of Activision, EA Sports and some others, EA Sports and some others, they started the journey much earlier. So as of today, you would expect that maybe over 80% of the games are being downloaded rather than you go to GameStop or some other places to buy the game on a piece of kind of like CD or DVD. And so Nintendo is benefiting from that as we speak. So they are going to make a higher margin because people downloading the game, they don't need to pay the distributor, they don't need to have the games made in a box. And then secondly, that they have been launching a lot of new games or the variant of their IP, right? So you have seen like a new version of Zelda, Mario, and Pokemon. So there's just many games, and continuously people have been quite loyal in terms of interacting with those games. So anytime they have a new games being launched on the back of the same IP they have been building on, they are making more money on the back of that. So they are able to refresh their portfolio as we speak. And just to point out that this is the only Japanese company that we have in the fund. And we continue to like the developments within Mario. And then if you look at the market cap today, is probably a bit similar to what Microsoft has paid for Activision, which is about $70 billion. But Nintendo's business is a lot better than Activision, which is mostly through Call of Duty. They don't have the likes of Mario and all that stuff. Okay, whether Microsoft is allowed to buy Nintendo or not, I think that's highly debatable. But even without that, I mean, we like Nintendo as a standalone business, and of course, we look at the valuation, look at the cash on the balance sheet. It's probably about maybe 15%, 10 to 15% of the market cap is in cash, which we hope that what's going on now in Japan, if you follow the Japanese market, that maybe they could be even more shareholder friendly, and maybe some of this cash could be deployed into either paying a high dividends or maybe share buybacks that we have not seen yet. I think they're still quite old school in terms of distributing those cash back to shareholders, but that could change too. So we continue to like our holding in Nintendo.
Great, thank you. Right, so I've hosted a few of these now, Stephen. I have to say this is by far and away the most questions we've had in. So thanks for everyone that is sending them in. Apologies if we can't get to you all, but I think it's a testament to how interesting a presentation it was. So what I'll go with next is, can you delve into payments industry? Clearly, Visa and MasterCard have had an incredible run, but it appears to me to be an area of huge potential disruption. There are just so many payment / e-commerce companies. So any thoughts on that?
Yeah, it's quite complicated in terms of this payment space, but on a very high level, the biggest threat to MasterCard and Visa's payment network is crypto. Okay, that is the biggest threat. Like if one day we stop transacting in cash, let's say going to a merchant, going to a pub, going to the kind of the supermarkets, not using our debit card or credit cards, and then we're using some card that are basically done through crypto or Bitcoin, then they are going to experience less of a growth in terms of consumer spending, right? Like, so they're going to have a smaller share compared to now, which they have the most share. But if you're just referring to, oh, there's a lot of payment applications, or whether it's buy now, pay later, the Klarna, whether it's the PayPal wallet, the Apple wallet, there's so many others or different ways of kind of making payment. You still need to go through the MasterCard and Visa network. Like you can't escape from that, like unless you're paying cash, which no one's, it's very difficult to find an ATM machine now, because like sometimes I do like to have some cash in my wallet, and I have to probably walk a few streets just to get some cash from an ATM. And so cash is dying, as we all know. And so unless you think maybe cash would come back, or you would think maybe crypto or Bitcoin is going to be a preferred way of payment method, then any other things on top is just, the kind of developments are building onto the network that we have for the last many years. And of course, they remain the very prominent kind of players or duopoly within the space. And at the same time, I think one thing we shouldn't miss out on, which they don't normally talk about that, because they're very big companies, but they have made a lot of investment in some of these smaller kind of startup as well. Like even in the crypto space, they have made some investment into certain crypto platforms so that they could maybe learn from those experiences to whether they can enhance some sort of like security or checks so that maybe they can tie it up with what they have today. So we are quite comfortable if you are just referring to the competition for kind of the economics of MasterCard and Visa.
Great, thank you very much indeed for that. Right, I think we'll probably have to make this the last one, just conscious of time. But I'd say if you do have any more questions, do feel free to feed them back to us via whoever your sales manager is, or perhaps obviously get in contact directly with Blue Whale. But final question I have here is, do you think the geopolitical risks would affect emerging markets more?
I think it depends, right? Like I probably don't have a strong view on that because we don't invest into emerging markets. I mean, we are developed markets focused, and probably the furthest away in terms of companies, Nintendo, which is a Japanese company, but all other companies are either in Europe or majority of them in the US. So we don't spend a lot of time thinking about emerging markets. I would probably think it's a bit of a mix, because if you're referring to, let's say, India, like India is benefiting significantly on the back of kind of the Chinese issue, right? Like everyone is quite cautious about doing businesses with China. Company want to probably have less investment in China, but then where do you go? Like you probably want to go to India, which would, have a bigger population than China today, and the potential could be similar in the next many years to come. And then they have democracy rather than a kind of dictatorship in China, which is more acceptable to the Western world. So India as an emerging market is actually benefiting a lot from some of this. But then if you're saying, okay, what about like Taiwan or maybe some other countries in Asia that maybe if you don't want to do business with China, whether you're going to make more money or not, I think that's very debatable, isn't it? Like, I think it's just too complicated when you can talk about like South Africa, which is completely different. You can talk about Latin America, you can talk about the Middle East. And so we don't have a strong view. So I probably wouldn't want to expand too much on that.
No, understood. Thank you. Right, I'm afraid I think we're going to have to leave it there. But thank you once again. That was really insightful. I think I speak for everybody that's been listening this morning. Steve, I want to say that was really great. And say that I think the questions that we've had through and the number of signups that we've had this morning are absolutely testament to that. So we could probably go on for another hour or two with the questions I've had, but conscious of time to say keep it within the hour, we will have to leave it there. But we will have you along again soon, I'm sure, for another one of these. So thank you very much indeed. And thanks again to everybody that's listened in. As always, these we do put these online afterwards. So if you want to share it with any of your colleagues or you want to listen back, but all our Pulse webinars are available online and we can circulate slides to you as well. So thanks again to you, Stephen. Much appreciated. It's been great having you with us this morning, and thanks again to everybody that's dialed in to listen. Thank you.